there's a tremendous amount of information that's coming out, and we don't really know whether we're going to rebound on a uh, on a good note or a bad note with real estate, just based on the amount of defaults on leases. I say defaults, usually that's for mortgages, but the 60% approximately of the service industry is what is the retail leasing uh, business. So that has such a big impact. Normally, we're hit with manufacturing. That's what declines first. This time, it's just all been service. So there aren't a lot of predictive models as to how that's going to affect us. With that loss of job, uh, loss of jobs, what we're probably going to see is a hiccup uh, in the number of homes that are on the market. Now, so here's a house that I listed today, actually yesterday. And as of February, this was our competition in the neighborhood called Stonegate. But here, even in the middle of this COVID mess, this is the market as of today. There are absolutely no houses in the neighborhood available for sale. And so the inventory has become, looking back at this other one, three active listings in February, and just a couple of months later, we're looking at no active listings and everything closed. So if our inventory stays as low as it is, when this COVID lifts, we will have a great rebound, because even if the demand declines, we don't have any inventory. So nationally, we've been underproducing houses. And last time when we had the Great Recession and all of this stuff hit us, we were way overproducing houses, building many more than what the market could absorb. Well, this time, even with as robust as the economy was, we were underproducing. With all the new construction, we weren't meeting the demand. So the real question is, how does this rebound? So you ask the question when you're evaluating your own real estate is, what is the current supply of inventory, and then match that up to the demand, such as pending listings. Well, in this case, we have no pending listings, only closed listings. So even if there is very little demand, we only need one buyer in this neighborhood to be able to pull this off. Unlike anything that we've seen over, say, the past 10 years, where there's almost always been a house for sale. So the idea, if you're in any form of any transition right now, of course, if you're staying put, you're just staying put. But if you're in any kind of transition, if the market were to get worse, then we're going to see a whole lot more inventory, and that's going to be your competition. So the idea is, if you need to make a move within the next year or two, it's probably a decent idea to go ahead and sell now. You can see what the market is, you can see that you have no competition, and get it out of the way rather than taking the risk of what the future holds. But we still have, even on the upper end, there's been a decline in luxury inventory, not quite as much as this, where we have no supply, but for the past 10 years, we've just had way too much housing, say over 500,000 or maybe over 750,000. And the market times were very, very long. So that has declined substantially. And even with a hit here, it's a pretty decent time to sell a house, as long as you can nab a buyer. Now,
Carol, can I interject and just say something real quick, or do
please.
you just want to go through this presentation?
No, this is not really a presentation. It's me bouncing back and forth between some ideas that I want you to be able to think about, because we don't know. The idea here is we don't know what the future is. We literally have nothing to predict with, and so I want all of us to be able to have some salient points to measure from, and just be able to make decisions on the fly while we're out in the field, and help our buyers and sellers make those decisions while they're out in the field. We're out in the field because it's going to be changing by the day, and each price range is going to be different. One levels are going to be different than the two stories. The school districts are going to be different. So we have to evaluate that supply and demand, just like a old-fashioned economics class. Go ahead, Sabrina.
Okay, so I read something saying, that now, like, days on market used to be, really important, and once the days kind of escalated, people started worrying about the property. And I read an article saying, that won't be the case anymore because our screen time has increased so much with everybody staying at home, and then not being able to get out as much or do something. For one, the days on market isn't going to matter as much. And if you are thinking about selling, I've read to go ahead and get the property out now because there's people are just surfing the internet, and eventually they get to real estate. And again, just how important it is for your online marketing to have uh, your 3D marketing, your videos, your photography,
Right.
and how important it is for an agent to make sure that your house shows online the best that it can.
My small group this morning, we were talking about this being kind of like Christmas when the demand, people may not buy and sell right in the middle of the Christmas and holiday season, but they're definitely thinking about it. They're shopping. They may be even shopping who their realtor's going to be by connections and holiday parties, whatever it is that's going on. This kind of thing, that's really just indicating a pent up demand. That's why we see all that spring activity. So as realtors on the back end, we stay active and social, top of mind, helping people out, making connections, whatever we're doing in those slow times. This is one of those, and I do expect it to come back. Uh, there's just pent up demand. People have to have a place to live. There are always changes taking place with births, deaths, and marriages, divorces, all of that. It's creating different family unit needs, and what we are very likely to see is a big spike there. And the joke that I had, I had that little blurb on my radio, and it's been all over the internet of, can you just see the new sales pitches? Can you see your family being quarantined here? Not look at this great whatever, the fancy chandeliers, but think of it being quarantined here. And people are thinking in those terms of what I expect an explosion in home improvements because of this type of thing. More and more people offsing at home. Now, we've seen that change. I had talked to you about uh, this is the change in real estate just with EXP. When we opened Oklahoma here, and Rob, this is relevant to you if you can still hear, the when we opened Oklahoma, there were 150 real estate agents at EXP Realty, this crazy idea of a virtual company. And that was in 2012. And the real spike started to happen about 2016 when we began to like double every year. And now we're over 30,000 real estate agents who have discovered this virtual concept of working for home and from home. And that's where the 3D home tours come in, and all of this virtual stuff. People are realizing finally, after many years of having to twist arms to try things virtually, the real force has come from the market, and this COVID stuff of, well, if I have to be at home, I might as well learn it. And so there's this real adoption of this not even new technology. So exactly, Sabrina.
Mm-hmm.
So here's something else that I think is really, did that, you kind of made a statement, didn't really ask a question, but I think we've kind of talked that one through.
Yeah.
So I want to talk about the financial side of moving now versus moving later. So let's say there are two home sellers. Well, yeah, two home sellers. One decides to move now, one decides to move later. And selling now, let's say at $500,000, this is the price that the market will bring for a house at this particular, the two identical houses. You sell it today at 500,000. You purchase a $300,000 house, and the market declines by 20%. By 20%. Let's say the market goes down. We don't know this. It's just hypothetical, but regardless, it's going to go up or down. There are only two directions. So a 20% drop, the value later of what they have is $240,000. Had they stayed and moved later, $500,000, kept that $500,000 house, they lose $20,000 or 20% on it, because that's the loss in value for real estate. Then they've got 400. That's a $100,000 loss on that house by choosing to move later. So in moving down, if the market's moving down, it's better to take that loss on a lower value property. Of course, the opposite would be true if you're moving up. So if the market starts to slide down, then we'd want to tell our move up buyer, say, wait until we start to hit a kind of a stagnation, and then that's the time to buy. So take a supposed loss. Sometimes people will be saying, well, I want to get $325,000 for my house today that's only worth $300,000, and they can't sell it, but then they're missing out on a $600,000 house that's later going to cost them $700,000 if the market is improving. So it's our job to make sure we're watching which direction the market is going for their particular property. We can't take national numbers and then say, here's what's happening, because it's neighborhood specific. Just like we see differences in Maple Ridge and Cherry Street and Broken Arrow and Bixby. The neighborhoods are quite different between them. So the other issue of this is if we start to see a slide, and this could be something that has an impact, a positive impact on 60% of our people and a negative impact on 40. And so those who are having some type of job transition, or remember the last big downturn, you only really have to miss one payment. If you're a homeowner, you miss one payment, and it puts you in this cycle that you'll never get out of if you don't have cash to be able to bail yourself out. And lots of people are living paycheck to paycheck. So we don't have the same predatory lending practices that will throw us into that situation. And we certainly right now don't have the same surplus of inventory that's going to put us in that situation. But we could still run into a lot of clients who are struggling to make their house payments at all levels, even especially with the way oil has dropped so substantially. A lot of oil executives who have been very well heeled in all of their finances are having some serious problems right now, and may have to shuffle some things around. That could be just disposing of some assets, et cetera. But anybody could be finding themselves in a short sale situation. Remember, that is Stan's expertise. He's the one that was my partner working through all of this, and really did all of the things that I put my name on. He just did all the grunt work on the back end. So that's his real specialty. And I've maintained him as a Baskin real estate specialist, retained him to do that. And all of my stuff gets passed on to him. So keep him there as an extension of your team, and make sure you call on him to do it. He will work with you very closely and do an excellent job.
Well, and I just want to say that he helped a client of mine that got in trouble, and they got the house that they listed with him sold, I think, within 60 days. But anyway, I was so grateful to just turn it over to him. I didn't have to mess with it.
Can I move them into your house so I can close?
No, in fact, I've been afraid to even call them.
Well, and that's a struggle I'm having with a couple, of people wanting to actually, well, there's a different issues there, but it is difficult right now for people to move.
I have 2 spare rooms that I could rent out.
Oh yeah, I'll send them your way.
Now that we're having a little bit of fun, let's go. By the way, Pamela, since you don't have a headset on, I keep muting you because
that seemed to happen once I began to engage. It seemed to become more fun. Is that what you're saying?
That too, Dan.
I just say it. I'm just kidding. Go ahead.
No,
it is true.
Now let's go over the commercial side of it. Airbnb has taken a really big hit. My Airbnbs, I've lost 75% of my bookings, because we're all entertainment, travel. People will come in. We'll have nurses, and the 25% that are there now are travel nurses and people related to the health industry. My biggest hit is that people aren't coming for events. They don't come in to go to the BOK. They're not traveling for social issues. So all of those have been canceled. Airbnb had like 100,000 cancellations in a week, whatever it was an astonishing number. And so until that recovers, people who are Airbnbs, if you've got any investors that you've sold, they've been running Airbnbs, they may need to make some adjustment. So you might be hearing from them as to some different options for regular rental, or in my case, I'm working towards marketing towards people who need to be quarantined. If they have a high risk person at home, then they may, if they're in a job where they are exposed to potential have potential virus exposure, then they may want to stay somewhere else until some of this passes. So I've had several inquiries on that, and one of those turned into a new guest to be staying there for 30 days, maybe a little more. So that's a way to fill it. That's part of the transition. And the other, I forgot what it was. I don't know. Oh, the others, people like you, Stan, remember Airbnb is a really great way to have a short-term rental for people who are in between purchase or other leasing. So if you have a deal that's really close, but you're a week apart or 2 weeks apart or even a few months apart on occupancy issues, so one person needs to move in right away, make it a cost of sale and do a financial analysis on that. Is it worth it to go ahead and move, and then you don't have to deal with furnishings, everything just stays in storage. Many people are wanting to just dispose of what they have anyway, sell it off because they're going to a different type of living arrangement where they're downsizing substantially or they want to buy all new furniture. So keep all of that on the table.
Well, do you have such a thing available at the moment?
All my Airbnbs are available for that.
Oh,
now,
okay.
Mine are one bedroom, so they may not be a fit for what your people need, but you're also looking at the option, a hotel room, which is usually more expensive than what you can get an Airbnb for, and it's not comfortable living. So if somebody's going to be there for 2 or 4 weeks, then having an Airbnb can be, they can move in, they can settle, they're not paying extra for cleaning services other than what's required by the Airbnb host. So these are really great options. I've hosted a lot of people who have been, even with other real estate agents, using my Airbnbs in their transition.
Daryl, I have a question about that. You
Yes.
said you were marketing to nurses. How do you do that? How do you market to people?
Well, I don't market directly to them. I market through the Airbnb. So if you find a profile of an industry or a job, a profession of some sort, and you know they need certain accommodations, then you change your Airbnb listing to reflect those accommodations because that's what they're searching for. And it just kind of becomes a niche. So if I were looking only for weekend travelers, then I might have certain restrictions or certain benefits. And in my case, on my 8th Street property, I added washer and dryer connection for the building. So people who want to stay longer they now have that. And I added that just, I don't know, 18 months ago. And so our stays suddenly went from just a weekend traveler who didn't care about laundry to a lot of longer term interns, the nurses, people who need to stay someplace longer, but they have to have laundry facilities. So
Right.
use that with your Airbnb investors to make sure they're understanding where some of the perks can be. And that was the cost. That cost me a couple of $1,000s to add that. Well, if it hadn't happened to me.
Yeah.
And you know, just going back to housing and everything, like I know so many people are scared of 2008, of what happened then. And like you said, 70% of the mortgages industry went out of business. But like we are in a vastly different state than we were here now than we were in 2008. And so, you know, I think I read more than 50% of people have over 50% home equity in their homes. So even if there's a financial situation where you're losing your job or something, you're not necessarily gonna, you know, put your home on the market and not make anything or have people walk away from their homes. And what the government's doing this time is just, you know, vastly different and proactive. So, you know, we don't know how long this is going to last, and we are in uncertainty because we've never experienced this before, but we are, you know, our industry is in a lot better place.
Well,
I think like, not be so scared is important.
I would agree that'd be true and largely true. However, a lot of people's equity in 2008 was eaten away by depreciation in the market, and that could certainly happen. And there are liquidity issues out there, and the forbearance is creating liquidity issues for banks. And so depending on how long this goes on, this could begin to to affect financial institutions, and I'll let these other guys address that later in the week. But I wouldn't fall into the trap of these people saying it's not going to be any big deal and it's all so vastly different, because it is affecting the banking industry, and it remains to be seen how dramatically it ends up affecting them, because these people, they have to go ahead and make these mortgage payments on up the chain, whether they're collecting them or not. And so
and that was the discussion with Dan Newberry that was really so important. Is does this become a domino issue? And if we have our head in the sand, does this come get us? There's some feedback coming through.
That's Robert.
Maybe on you, Stan.
Well, I was going to pipe in because
I muted it.
I think it's important. I think it's important to recognize that the forbearance issue is a real possibility, because they've opened that door, and they and the stimulus monies are not coming very smoothly at this point. I actually used Bell Land Use to file for unemployment. The state's not prepared to have somebody self-employed to apply, so they've kicked me off their system, and I have to wait for the Department of Labor to give them their process. So they're talking about 4 to 6 weeks that I may get the money's returned to me or given to me. If I am the not the exception to the rule, if that's the rule out there, you could have hundreds of thousands of people that have completely lost income for 4 to 6 weeks, and the stimulus package is not going to save them to make a payment on their house, and the forbearance becomes a real issue for everybody to apply for. And if that happens,
yeah, and Robert, that is the point.
If that happens, what Stan says is real.
Yeah, if that happens, then that's the domino. And what we need to be, we can't go out, we shouldn't be going out really advertising all of that right now, preparing, the sky's falling, because we don't know that it is, and we don't know that it will. But it's our job to be the professionals who are educated through this type of discussion and understand where it could go. And so the time, if you don't have, let's say, if you don't have 5 years to wait this out, or whatever time frame it might be, if you need to be making a move, the interest rates are so low now, this is a real win to grab the low interest rates, get rid of whatever property you don't want to be holding over the next few years. And if that lines up with what your goals are, then do it now. Otherwise, refinance right now. We can get a lot of our people in. This doesn't help us, but it helps them, and that's what we're here for. Get our people in and get them refinanced at low rates and make it possible for them to stay in their houses. We've got a lot of people who are probably at 5% or so, and they can get if they've been there for a little bit, paid it down enough, they refinance their current balance, get it down to an even lower interest rate and a shorter term. So they take a 20-year loan, 5%, refinance it at 15 years for 3%, and we've just saved them lots of money per month, made it possible for them to accelerate the payoff, which then, even if the property value were to decline, then they're still able to hold their equity more, because each month they're paying more down on their loan balance. And that's where people also get burned, is they buy something for little or nothing down, they're stuck on that 30 years, and 5 years later they've got 25 years later, they've paid nothing on their principal, and they're trying to sell and cover all their costs and make money on their move, because they've got to pay movers and all that other mess. Well, then they're stuck and they can't get out, and that's what we've seen every time there's a downturn.
The question I had out of everything you just said, Daryl, was, and this is kind of self preservation at that point, do we think that in a long period of time will the market value of the houses drop, or could they drop? What is the scenario that they drop? I mean, because right now I've got $60,000 of equity in my house. I could save myself a lot of trouble to go out and refinance and put some cash in the bank and live on it for 4 or 5 months. That's a real negative to me because that's
But
against
then,
what
yeah,
I've
but
set
then you
up for
have to
the
pay it.
future. But then if the value of property is going to drop, I don't want to lose that opportunity. I'd rather be upside down and in a basket with a whole bunch of people instead of
So,
just by myself.
so that becomes the personal plan. What is your goal? What is your personal plan? And we're talking our people through this all the time. So we need to not be focused on what we think is best all the time. We need to tell them what we think is best based on what we're understanding, but we also need to explain why we think it's best so that they can match up why with what their own why is, what their goal is, and they can determine for themselves. Because the fact is we could all wake up tomorrow, the market could, this could all be fear discussion today, the market could be fantastic, and we look back and it was all over nothing. I don't believe that's the case. I think it's going to have some hiccups, and it's going to be like a train, pulling against each other, and take it a little while to get going again. And during that time, during all of those changes, there are sweet spots of opportunity. We see that every time the market turns around. When interest rates go down, typically prices go up. But if you buy while interest rates are low when they've just gone down, then you get the sweet spot because the prices haven't typically started to go up yet. It's just there's that lag. So we need to try to catch it on that. This is one of my own clients said this morning, and I love the example. He said, this is a game of musical chairs. And when the music stops, there are going to be some people left standing. And we don't want to be those left standing. So all we have to do is plan ahead and help people plan ahead with a strategy. A plan A, what happens if that doesn't work or it goes a different direction? This is my plan B. And then they're not caught with such shocking revelations of things that really were right there in front of them, but they had no way to size it up. Most people are living today, and they're not really thinking about what does this look like in 6 months or a year. You brought up something really important, Robert, that people who don't deal with real estate and real estate financing don't think about too much, and that is the ability to get financing today may not be there in 6 months. People think, oh, I can refinance my house, I can get my 60,000 out. Well, that may not be the case in 6 months because your property value may have gone down. The appraisals will be based on the current values, et cetera. Even if interest rates are low, your employment may not be the same. So get all those things on the table and then evaluate them and see where they fit together in the puzzle.
Well, and another thing that I've found is going on out there is because of all the refinancings, that's also affecting liquidity. But several mortgage companies have raised their minimum credit scores now as well, and interest rates have moved up a bit because of the supply and demand factor of lack of liquidity.
Dan also reported that they are raising interest rates. Pardon me, the Fed's not raising the interest rates, but because of the demand, the interest rates by the retailers, so our mortgage companies that we deal with every day, they're raising their rates a little bit because there's so much demand. They're just raising them. They can, supply and demand. Robert?
And the credit score is going to get affected because there are going to be more people enter into issues of not being able to make payments. That's going to change quickly, in my opinion.
Yep. And there's your domino. Now you take in this example that I showed you of a house I just put on the market, in 3 weeks, house payment's not able to be made. Okay, we're going to have to sell it. Now we have 2 competitors, 3 competitors, 4 competitors in that same neighborhood. The landscape's not the same. So we always want our clients to be, when they're sellers, the only choice. And of course, when we're on the buying side, we wait it out and find it, when there are multiple choices, and then we can bargain with people to get what they want. But even then, casting out in the future, if you wait for that perfect deal, if you're a buyer and you wait too long and you find the right house, but your interest rate is 1% higher, how much does that cost you over your period of ownership than if you had just paid $5,000 more for it in the first place, or 10,000 or 20, whatever those numbers are. Those are the financial calculations that are quite simple. We all know how to do them. Those are the financial calculations that have to be thought through. And our job is to take the emotion out of it and put it down on a very factual level so that our clients can look at it and make the best decision. Okay. Anything else?
Good conversation.
Yeah, I do. I want to thank all of you for participating. And I may use, with your permission, I may use clips of this conversation for some of our Cameo videos that help convey that message for our people. Okay, good. Hey, Rob, good to see you today, or talk to you, and always good to have you around. Always let us know if we can.
I am enjoying the conversation because I'm going to be selling a condo soon, and I'm in that interim stage where I've sold the $500,000 house and I'm building a new house, and so
good for you, by the way.
I can relate to everything. What's that?
Yeah, good for you. I'm really happy that you are not trying to sell that right now.
We thought about it going into an election year. We thought, I don't know that we want to be there, and who would have known that COVID came up?
Yeah. Well, then there's always that insurance. I don't know if I told my team here, think of it when you're talking about this with clients, think of it in terms of explaining it as an insurance policy. It could be better, it could be worse, we don't know. So if you were buying an insurance policy, making this decision today, what is the assurance of what you have in front of you? What is that worth to you? Because that's really what we're buying. We know what today is. We don't have any clue other than some loose projections, especially right now with all this chaos. We just don't know what it's going to be. So, and time runs out. Time can be your friend or it can be your enemy. So keep that in mind too. If you don't have time, we all run out of it eventually when we go 6 feet under. Kind of morbid, but
yes.
It happens.
No, it does happen. It will happen. Guaranteed.
Yeah. All right, guys. Well, you know how
that's a joyous note to end it on, Daryl.
Yeah.
We're all gonna die.
I was going to say that.
Sorry if I surprised you on that.
All right, guys. Thank you.
All right. Enjoyed it.
See you later. Bye.